How to recognize an economic crisis lurking right before your eyes. There is a bitter truth. Most major crises, from the Great Depression of 1929 to the global financial crisis of 2008, were not sudden accidents. They were the result of an accumulated process of imbalances, heralded by a series of clear warning signals. However, human complacency, greed, and rose-tinted glasses caused us to ignore them. Early warning signals: financial imbalance. Crises always originate from tension within the financial system. These are the first signs that we need to monitor: asset bubbles and speculative fever. This is probably the most classic and clearest sign. A bubble occurs when the price of an asset class, stocks, real estate, cryptocurrency, tulips, rises far beyond its intrinsic value, fueled by expectations of future returns and herd mentality. Bubbles are inflated by cheap money, low interest rates, and easy access to it, loose credit. When money is easy to come by, people are willing to pay irrational prices, thinking that a bigger fool will buy it from them at an even higher price. Signs of a bubble. When non-experts, taxi drivers, barbers start excitedly talking about investing in a specific asset. This is the peak of herd mentality. Irrational quantitative valuation, the PE ratio, price to earnings for stocks, or the ratio of house prices to the average income of the population, skyrockets to historically unprecedented levels. Investors start providing justifications that this bubble is different due to a new technology or business model. This is a sign of collective self-deception. The 2008 crisis occurred because of an irrational belief that U.S. house prices would never fall. Banks recklessly extended credit to those unable to repay, based on the assumption that the collateral, the house, would always increase in value. When interest rates slightly increased and house prices began to plateau, these debts defaulted en masse, collapsing the entire global financial system. Suspicious increase in debt. Debt is not bad, but excessive and low-quality debt is poison. Economic crises are almost always accompanied by a massive accumulation of debt, especially private debt, households and corporations. And private debt to GDP. Look at the private sector debt GDP ratio. When this ratio increases too quickly, surpassing historical levels, it is an extremely strong alarm signal. History has shown that countries with a rapidly increasing private debt to GDP ratio often face crises. Excessive leverage. Financial institutions and investors use borrowed money to invest many times more than their equity. A small market shock can wipe out their entire capital, forcing them to sell off assets, causing a chain reaction. The emergence of risky assets, bad debt, complex and opaque financial instruments like CDOs, collateralized debt obligations, designed to hide risk and sell it to uninformed investors. This disperses risk throughout the system, but no one knows where the actual risk lies. Excessive financialization. Financialization is the process by which economic activity shifts from real production, producing goods and services, to financial activities. Profits come from trading, not production. When non-financial companies, e.g., tech companies, car manufacturers, earn the majority of their profits from fund management, investment, and asset trading instead of their core business operations. This indicates a shift in the economy's priorities. The rise of shadow banking, financial institutions that are not traditional banks, hedge funds, insurance companies. Money market funds perform banking functions but are not subject to strict regulatory oversight. This system is a fire starter in a crisis, exemplified by the collapse of Lehman Brothers and AIG in 2008. Jobless growth, high GDP growth that fails to create enough jobs or significantly improve the income of the working class. This disparity suggests that money is mainly concentrated in financial assets, stocks, real estate, rather than flowing into the real economy. Signals from the real economy. While the financial sector celebrates, the following signs from the real economy signal an impending storm. Inverted yield curve. Under normal conditions, long-term bonds, e.g., 10-year have a higher yield than short-term bonds, e.g., 2-year. This is because investors demand extra compensation for locking up capital for a longer duration. Yield inversion. When the yield on short-term bonds is higher than the yield on long-term bonds, this occurs when investors anticipate a recession or a sharp drop in inflation in the future. They rush to buy long-term bonds to lock in the current yield before it falls when a recession occurs. The central bank usually cuts interest rates, thereby reducing the long-term yield. Conversely, the central bank Fed raising interest rates to curb inflation increases the short-term yield. Predictive power. The U.S. yield curve has inverted before every recession since 1950, though, with a delay of 6 to 24 months. This is an economic prophecy that cannot be ignored. Sticky inflation and tight monetary policy. Crises often follow a period of high inflation that forces the central bank to act aggressively. Persistent inflation. Inflation that is not merely due to a temporary shock, but has become deeply ingrained in consumer and business expectations. When inflation remains high, the Fed, or central bank, must raise interest rates, rate hikes, forcefully and continuously to cool down the economy. The Fed's breaks raising interest rates is an act of breaking the economy. High interest rates increase borrowing costs for businesses and consumers buying homes, cars, reducing investment and spending, thereby slowing down growth. Hard landing risk. When the Fed acts too slowly or too aggressively, it easily pushes the economy into a recession instead of achieving a soft landing. A crisis is always lurking when monetary policy shifts abruptly from easing to tightening. Wealth gap and decline of the middle class. Social imbalance plays a surprising role in triggering crises. Reduced purchasing power. When wealth is concentrated at the top of the pyramid, the ultra-rich, the middle and lower classes must rely on debt to maintain their standard of living and spending. This makes the system more fragile to shocks. Middle-class spending is the primary driver of the consumer economy. If this spending declines, aggregate demand will fall, leading to a recession. Political social pressure. A large wealth gap creates political polarization, leading to unstable and untrustworthy economic policies, discouraging investors and exacerbating the lack of confidence when a crisis strikes. Signals from psychology and behavior. Crises are not just about data, they are also about collective psychology. Experts always monitor these non-quantitative signs. Greed overcoming fear. When people forget about risk and only focus on profit. Increased speculative investment. When money flows into high-risk assets, penny stocks, speculative startups, meme stocks without fundamental consideration. Fear of missing out. People, including large investment funds, are drawn into buying a rising asset just because they fear missing out on making money, not because they believe in its intrinsic value. VIX, Volatility Index at record lows. VIX, also known as the Fear Index, measures the expected volatility of the market. When the VIX is low, investor sentiment is calm. It often signals excessive complacency, and a sudden shock can occur at any moment. Loose lending standards. This is a sign of carelessness and complacency in the financial system. Lending without conditions, typical in the 2008 crisis, where no income, no job, no assets, home loans, granted without requiring proof of income, employment, or assets. This indicates that banks prioritize loan volume over debt quality. Lender unprotected debt contracts appearing in the corporate debt market. These loans have few or no clauses protecting the lender, requiring the company to maintain a certain debt-equity ratio, COE. When lending standards become loose, it is a clear sign that risk is being dangerously underestimated. So, who is behind these signs? In any crisis, there are always losers and winners. The financial elite, also known as financial magnates, are not necessarily the direct cause of the crisis, but they are the ones who exploit it perfectly. Mechanism of manipulation. Phase 1. Pumping cheap money. The financial magnates, through their influence on policy and the banking system, advocate for prolonged low-interest rate policies and quantitative easing. They use this money to buy assets, stocks, real estate in large quantities, thereby pushing prices up. They promote a speculative mindset through the media, encouraging ordinary people and small businesses to take on debt to participate in the market. You will miss out if you don't participate. Phase 2. Distributing assets and short selling. When asset prices reach an irrational peak, for example, when the market PE reaches an excessively high level, the financial magnates quietly begin to sell off, dumping their assets to latecomers, ordinary people, individual investors, pension funds. At the same time, they increase their short positions on assets they predict will collapse. Phase 3. Triggering the collapse. When they realize the system is overly stressed with bad debt and the bubble has reached its limit, they may use actions such as calling on the central bank to normalize interest rates, raising rates to fight inflation, or selling off assets on a large scale to cause panic. Example, the collapse of a small bank can be triggered and exaggerated to create a chain effect. Phase 4. Accumulating assets at fire sale prices. When the market collapses, asset prices, homes, stocks of good companies, land fall to disastrous levels. Small businesses go bankrupt because they cannot repay their debts. People have their homes foreclosed because they cannot pay their mortgages. The financial magnates, those who exited the market or bet on the collapse, use available cash to acquire these high-quality assets at dirt-cheap prices. Result, after each cycle, wealth is redistributed from the middle and lower classes to the ultra-rich. This is a continuous loop that experts call the Great Confiscation. An economic crisis is not a storm that appears out of nowhere. It is a process heralded by the piling up of financial imbalances, signs of real economic weakness, and collective complacency. Keep an eye on the inverted yield curve and the rise in private debt. These are the most reliable indicators. Beware of asset bubbles inflated by loose credit and a greedy mindset. And above all, be aware of the mechanism of asset redistribution hidden behind every boom and bust cycle. These signs are not just numbers. They are the footprints of those seeking to manipulate the system. In the current context, which sign do you consider the most worrying? Persistent inflation, high corporate debt, or the looming inverted yield curve? Can the central bank truly control the boom-bust cycle? Or is it just an unwitting or deliberate tool in the hands of those behind the financial system?